Welcome to this business tax roundup for this month. My name is Dean Wootten. The first case we're going to look at is one concerning Mr. Adrian Chiles, and he's a well-known BBC ITV personality on TV, and it was whether IR35 applied or not. Now, in 1996, the BBC required Adrian Chiles to cease employment with them and continue providing services through his personal service company. That company was called BBL. HMRC argued that during 12-13 through to 16-17, the IR35 rules were in point on the BBC and ITV contracts, and they issued determinations for taxes, etc., of £1.7 million. BBL thought otherwise. Now, the first tier had to consider the hypothetical contracts between the BBC ITV and Mr. Chiles. Was it one of employment or self-employment? If it was of employment, then IR35 would apply. There's common ground that there was mutuality of obligation under the BBC contracts, but the tribunal also found mutuality of obligation applied to the ITV contracts. Yet despite no obligation for the ITV to offer work, they did indeed offer paid work, and ITV called upon Mr. Chiles to provide his services. The tribunal also went on to consider who controlled what, where, when and how the work was done, and they concluded that there was enough editorial control to mean that there was a sufficient framework of control to be of employment. So the first is starting off by looking at a couple of the big factors, or the perceived big factors: mutuality and control. Both of them, in Mr. Chiles' case, were pointing towards employment. They then went on to consider in business on his own account. Now, this is where it starts to get really interesting, because it's a slight departure, fine-tuning of the test. Now, Mr. Chiles had contracted with nearly 100 different third parties. He had undertaken large amounts of work on potential other projects. He had also turned down a significant number of appearances on television. He appointed a managing agent, paid them 15% to promote and further his career. An employed person doesn't do that. He appointed a personal assistant to manage his day-to-day affairs. As far as the tribunal was concerned, Mr. Chiles was building a business. But were the hypothetical contracts with the BBC and ITV separate to that business, or were they part of the business? Now, the contracts involved Adrian Chiles working for both ITV and the BBC at the same time. There was work, research, preparation, and it was up to him when and where he undertook that. He also provided some tools and some resources for better performance of his duties. There was no substitution, but that's not uncommon in this industry. They want a particular presenter. And it's not unusual for any business to have individual clients contributing a large proportion of turnover. So as far as the first two are concerned, the ITV and BBC work fell fairly and squarely within the scope of his existing business activities. And we're looking at the bigger picture. The hypothetical contracts form part and parcel of his own business, and the IR35 did not apply. And I think this is quite a refreshing case in many regards, because they move away from the mutuality, the control, the substitution, and they just look at it in the round, and they just say, well, is this individual in business? Now, if they are in business, there's enough factors there to suggest he is in business. Are these contracts within that business activity? Yes, they are. So therefore, this is outside of IR35. We'll now move on to compensation arrangements and consumer redress. Now, this case is BES Commercial Electricity Limited and BES or Business Energy Solutions Limited. Now, the companies admitted 7 regulatory breaches, and a settlement agreement was required. Now, the compensation had to be paid to affected customers, the compensation arrangements, and they had to make a charitable donation to the Money Advice Trust, and that was the consumer redress. Now, the companies claimed these amounts as tax deductible. HMRC said, well, they can't be because they're penalties, and penalties are not deductible. But the companies argued that these payments were incurred wholly and exclusively for the purposes of their trades. Now, and if they didn't get that, then they wanted the consumer redress payments as a charitable donation, so deduction for that one, via a different route. Now, first they looked at this and they said, well, to be incurred wholly exclusively for the trade, the payments must be made for the purpose of earning profits. In prior cases like McKnight and Shepherd, it has been decided that payments were non-deductible as they were penalties, and these penalties were not incurred when they were the company to generate profits. So McKnight was a stockbroker who had regulatory breaches, and he had to pay penalties because of those breaches, and it was held that they weren't deductible. They were unfortunate incidents which followed after the profits had been earned. They hadn't been incurred to earn the profits. Now, in this case, the settlement agreement payments avoided higher off-gem penalties. Now, applying McKnight, the payments were not deductible. They were made in order to punish the companies. They were penalties. This isn't a case about the fees, like the legal fees. That's a different matter altogether. This is about the penalties themselves, and they are not deductible. Then went on to consider whether the consumer redress payments were charitable donations. Now, qualifying charitable donations only qualify if conditions A through to F in section 191 of the Corporation Tax Act 2010 were met. HMRC accepted that conditions A to E were met, but challenged condition F. Now, condition F, it's where if you have benefits associated with the payment, then you breach condition F. You can't have benefits associated with the payment. It's got to be a freely given, no strings, benefits attached type payment. Now, the Tribunal agreed with HMRC. The agreement made it clear that if sums were not paid, the penalty would be higher. Therefore, the consumer redress payments gave the companies a right to pay a lower sum overall, and that was a valuable benefit. That breached condition F. It wasn't a charitable donation. So the company's appeal on that condition, that provision, was also dismissed. Let's now look at a sideways farming loss relief case. And this case concerning an individual that built a working farm. We decided to convert to organic production with a view to selling produce direct to the public. He had no farming experience whatsoever. Occasionally employed a manager, but it wasn't done on what you might say an experienced farmer basis or a competent basis. His activities often jumped from year to year and eventually did revert to conventional farming. But this individual made losses over 17 years, finally becoming profitable in 12-13. And he claimed sideways loss relief for the 5-year period to 11-12. So he's trying to utilise that 5-year rule, that if you don't make profits for 5 years, then you don't get relief in that 6th year or 5th year. That's what he's trying to rely on, but it's an interesting interpretation of that rule. And HMRC denied relief on the grounds that there's no expectation of profit. Now, the first tier allowed the appeal, but that's not important because it was overturned by the upper tribunal, and the Court of Appeal have now agreed with the upper tribunal. Now, this 5-year rule can be extended if farming activities were expected to be reasonably profitable. And when looking at that, you must consider the activity of a competent person. So, for example, if it was expected that, yes, you would make a profit, but for the activity you've gone into, it's year 7 that you're going to make a profit. Now, in that particular situation, the 5-year rule can be extended because a competent person would expect to make a profit by this point. Now, in this particular case, the individual made losses for 17 years. Based on expert evidence, he should have made profits if he was competent within, say, 10 to 14 years, something like that. He didn't make profits until 17, 18 years down the line. So therefore, that 5-year rule was not effectively applicable, and you couldn't get those sideways loss offsets. So sideways loss relief was not available. 17 consecutive years of losses doesn't mean towards the end of it you can start getting loss relief, because at that point you get close to profitability. This individual should have made profits within something like 10 to 14 years. That's what a competent farmer would have been. And therefore, the 5-year rule, I don't think it would have been extended in that situation, but in theory it could have been. But he still didn't make a profit in that time frame. So therefore, the 5-year rule is effectively denying the loss relief. You haven't made profits for 5 years, no expectation of making profits within a reasonable space of time, so therefore no sideways offset. Let's look at a few VAT cases. This one concerned the Reverend Jane Taylor, trading as Mill House Retreats, and she was an active priest on the Church of England, in the Church of England in Exeter. But her primary work, she wasn't actually paid, she wasn't a paid minister, so her primary work was a director of Mill House Retreats, and they provided spiritual welfare. Now, she claimed that Mill House Retreat was state regulated by the Church of England, and as such, it provided exempt welfare services. Now, to get exempt welfare services, she needs to be state regulated, and that was her argument. She thought she was. The HMRC disagreed, and they said, well, you're not state regulated, so therefore your activities are standard rated by default. And the Reverend Jane Taylor appealed. Now, in the first two, it was agreed that welfare services does include the provision of spiritual welfare. But to qualify, you need to be state regulated. I mean, welfare services is looking after young people, like children's nurseries, old people, care homes, rest homes, etc. People, disadvantaged people. So it's a wide definition of welfare services. But if you want the exemption, you have to be state regulated. Now, to qualify as state regulated, the services must be linked or controlled by a government minister or an Act of Parliament. Supervision by the Bishop of Exeter, a minister of the Church of England, was not supervision by a government minister. Consequently, the Mill Hill Retreat was regulated by the state, but it was not state regulated. And that's the key for exemption. So unfortunately, the appeal was dismissed. The income she got was taxable. And I'm presuming she's providing it to individuals. So therefore, it's a real kick in the teeth if she has to charge VAT on her income. We've got quite a big case on the recoverability of VAT on professional fees, and that's Hotel Latour Limited. Now, Hotel Latour Limited was the 100% holding company of Hotel Latour Birmingham Limited, amongst others. And they provided management services to the subsidiary, and they were in a VAT group. Now, the parent co decided to develop a new hotel in Milton Keynes, and they sold the Hotel Latour Birmingham Limited and borrowed the shortfall from a bank. The parent co then claimed VAT of £77,000 on professional fees when selling the subsidiary. HMRC disallowed the claim. When you sell shares, in their mind, it's exempt, and therefore the fees related to that exempt supply and were therefore not deductible. The parent company appealed on the grounds that professional fees were part of the sale process used to fund the development of a taxable activity, and there was a direct and immediate link between the sale of those shares and the intention to make taxable activity or supplies from this new hotel. Now, the first tier confirmed that their share sale is an exempt supply, but VAT incurred selling the shares could be recovered if funding a new taxable activity. Cases like Frank Smart and ABSKF have proven that or established that. They did in a way supersede the older case of BLP, and the ECJ have hinted that if the questions in the BLP case had been asked in a slightly different manner, then they might have got a different answer. I mean, BLP has always been professional fees in relation to the share sale, direct immediate link, exempt, you can't recover. But subsequent cases like Frank Smart, ABSKF, they are questioning that. And so, well, actually, why are you selling? Now, these professional fees reduce the amount available for the new taxable hotel activity, so they were a cost of that activity. They were a cost component of that activity, which is obviously important from a VAT perspective. And as far as the tribunal are concerned, there was a direct and immediate link between the share sale and the new hotel development, and therefore VAT on professional fees was reclaimable. Now, I know HMRC don't like this case. They may well take it to appeal. But at the moment, the first tier is saying if you are selling to raise funds for a taxable activity like you are in this particular situation, then the fees can be deducted. Now let's look at a case concerning recoverability of input tax. Now, ZipFit supplied vitamins and minerals by mail order, and the Royal Mail supplied postal services to ZipFit under contracts which at the time everyone thought was exempt. Now, it's later found that those supplies should have been taxable, and this was as a result of the TNT Post case. Where postal services are priced individually, then you've got standard rated supply. Now, the Royal Mail did not seek to recover VAT from their customers. I mean, in theory, they should have charged ZipFit VAT, but they didn't seek to pursue that avenue. And HMRC did not issue claims against Royal Mail for the VAT that they should have charged. And I think they consider Royal Mail had grounds for defence based on legitimate expectation. So effectively, the services going forward were taxable, but nobody's going back and correcting what had gone before. Now, ZipFit believed payments to Royal Mail should have been regarded retrospectively as including VAT, and they therefore submitted 2 applications for the deduction of input tax plus interest. HMRC dismissed both applications. The suppliers in question had not been subject to VAT, and ZipFit had not paid any tax. Royal Mail didn't charge them VAT. Royal Mail didn't provide them with a VAT invoice. So ZipFit's claim was a little bit tenuous, to say the least. Now, the issue progressed up to the Supreme Court, who referred the matter to the ECJ. Now, under Article 168A of the Principal VAT Directive, VAT could not be regarded as due or paid if the customer and the supplier had mistakenly assumed suppliers were exempt due to an incorrect interpretation of EU law by the national authorities. Consequently, the invoice issued did not refer to VAT. The contract between the customer and the supplier stated that if VAT was due, the customer should bear the cost, and there were no steps to recover that VAT in good time. So any action to recover unpaid VAT was time-barred. So as far as the ECJ were concerned, there was no VAT. And VAT in that situation is certainly not recoverable. Well, that concludes the business tax roundup for this month. My name's Dean Wootten. Thank you for listening.